All right, today we're diving deep into one of the world's biggest and, let's be honest, most complex companies, Microsoft. Let's get right into it. So, when you hear the name Microsoft, what comes to mind? Probably Windows on your laptop, right? Or maybe your Xbox. But here's the thing. If you're looking at this company as an investor, you've got to ask yourself, what is the real engine driving its incredible growth? Well, the answer is way bigger, more complex, and frankly, a lot more fascinating than just consumer gadgets. We're going to crack this thing open and really look at the powerhouse components that truly make this tech giant tick. Okay, let's kick things off with our first section, Microsoft Beyond the Desktop. Because, to really get a handle on the company today, we have to look way past the screen you're probably staring at right now. Right, so this is the Microsoft we all know and, well, use pretty much every day. You've got the Windows operating system, of course. You've got Office for all your documents and spreadsheets, Xbox for when you want to unwind, maybe even the Edge browser. These are all household names, for sure. But, and this is the key part, they are just the tip of a very, very large iceberg. All right, next up, the 3 pillars of power. This is where we get into the nitty-gritty, the real financial guts of the company. How does Microsoft actually organize itself to make all that money? Okay, now this chart, this is super revealing. Just look at how the revenue breaks down. You've got these 2 absolute monsters, productivity and business processes and intelligent cloud, both pulling in around $33 to $34 billion. And then you have the segment with Windows and Xbox, more personal computing way down here at just over $14 billion. I mean, that's less than half of either of the other 2. This tells you exactly where the real money is being made. So that first pillar is productivity and business processes. The best way to think about this is it's the engine room for countless businesses all over the world. We're talking about Microsoft 365. And get this, with over 450 million paid commercial seats. Plus, they own LinkedIn, the professional network, and their business software, Dynamics 365. It's the whole shebang for running a modern company. Then we have the second pillar, the intelligent cloud. And honestly, this thing is an absolute juggernaut. The star of the show here is Azure, Microsoft's cloud platform that goes head-to-head with Amazon's AWS. And just check out that growth number. Azure revenue rocketed up 39% year over year. That is just explosive growth for something that's already so massive. And that brings us to our third and final pillar, more personal computing. So this is where all those familiar products we talked about at the start live. You've got Windows, Xbox, which is now even bigger thanks to that huge Activision Blizzard deal, Surface devices, and Bing's advertising business. And yeah, while it's the smallest of the 3, let's be real, it's still a massive business, and it's the face of the company for most of us. Okay, so now that we've got the pillars down, let's talk about the single biggest thing being layered on top of all of it, our next section, fueling the AI revolution. And trust me, Microsoft isn't just playing around here, they're all in, aiming to completely lead the way. Microsoft's entire AI play, really, it all comes down to one absolutely critical move. Its deep, multi-billion-dollar partnership with OpenAI, the folks behind ChatGPT. This isn't some little side project for them. It is the foundational bet on their future. The whole plan is to weave AI into absolutely everything they make. And you can already see this bet paying off, big time. Let's look at GitHub Copilot, their AI tool for programmers. It's already got almost 5 million paying subscribers, and its user base, it exploded by an incredible 75% in just 1 year. But hold on, because the adoption inside their core business software is even more wild. Microsoft 365 Copilot, that's the AI assistant in Word, Excel, Teams, all that stuff, has already hit 15 million paid seats. That is a mind-blowing 160% jump year over year. It's crystal clear that businesses are absolutely hungry for these new AI tools. Now, all this amazing AI tech, it doesn't just magically appear, right? It needs a ton of physical hardware. And that brings us to a really important term for any investor, capital expenditure, or just CapEx. Don't worry about the fancy name. All it means is the money a company spends on stuff to grow. For Microsoft, that stuff means building these gigantic data centers packed with powerful chips. So just how much is Microsoft spending on this stuff? How about $37.5 billion? And get this, that's not for a whole year. That's their CapEx for a single quarter. I mean, that number just screams how serious they are about building the infrastructure to win the AI race. Okay,
So, with all this mind-boggling spending and insane growth, let's zoom out and look at the whole picture from an investor's angle. That's our next section: stickiness, growth, and risk. What makes this business so darn strong and, what could possibly go wrong?
To really get why Microsoft is so powerful, you have to understand this thing called RPO, or Remaining Performance Obligation. Again, don't let the jargon scare you. It's actually a simple and really powerful idea. Just think of it as pre-booked revenue. It's the total amount of money that customers have already signed on the dotted line to pay Microsoft down the road.
And this chart, wow, it just perfectly shows the power of that pre-booked cash. Just look at that jump. Their commercial RPO shot up from just under $300 billion to an incredible $625 billion in 1 year. That's a massive, massive backlog of revenue that's already locked in.
So why is that number so huge? Well, it all comes down to a word investors love: stickiness. See, once a company builds its entire operation on Microsoft's platforms, like Azure and Microsoft 365, the pain of leaving is just enormous. It's super difficult and super expensive to switch to a competitor. And that creates this incredibly powerful competitive advantage, what people call a moat around the business. But hey, no investment is a sure thing, right? It's always a balancing act. You've got the good and you've got the bad. So on one side, you have this incredible customer loyalty, backed up by that $625 billion backlog. That's the upside. But on the other side, the company is facing a pretty big cloud on the horizon, a potential tax bill of almost $29 billion from an IRS audit that's still going on. A digital giant this large really keep expanding in a meaningful way, or has it just hit its peak? Well, the data gives us a pretty loud and clear answer: a compound annual growth rate of over 14%, and that's every year since 2016. Now, to put that in perspective for you, that rate is way above inflation. This isn't just them hiking prices. No, this is real, substantial business expansion, year after year after year. So to really get how they pulled this off, we're going to break down our analysis into 5 key parts. First, we'll talk about their incredible growth comeback story. Then, we'll analyze what we're calling their digital moat. After that, we'll see how they stack up against their biggest rivals, peek inside their growth engine, and finally, we'll take a hard look at the threats lurking on the horizon. First up, the growth comeback. It's easy to forget that Microsoft actually had a bit of a stumble after they had to restructure that whole Nokia acquisition. But what happened right after that dip? Well, it's nothing short of a masterclass in how to turn a company around and execute a strategy perfectly.
Just look at this timeline. It tells the whole story. From a low point of about $85 billion back in 2016, you just see this relentless climb. They get back to strong double-digit growth, and even when the whole economy slowed down in 2023, the company still grew. And now, projections for 2025 show things are speeding up again. This isn't a fluke. It's a really clear pattern of resilience and smart expansion.
So you have to ask, how is this growth so consistent, so durable? Well, it really comes down to one of the most important ideas for any investor to understand: the competitive moat. A competitive moat, it's just a simple way to describe the sustainable advantages a company has over its competition. Think of it like a castle, right? The business is the castle, and the moat is that deep, wide ditch all around it that keeps attackers, or in this case, competitors, from getting in and stealing the profits inside. And let me tell you, Microsoft's moat is incredibly powerful, and it's built on 4 huge pillars. First, there's the sheer scale of their infrastructure. I mean, billions and billions invested in data centers all over the world that are pretty much impossible for anyone else to replicate. Second, the deep integration of their products. Just think about how Teams, Office, and Azure all work seamlessly together. Third is trust, especially with governments who really rely on their cloud. And number 4, and this is the big one right now, their leadership in AI, which was cemented by that game-changing OpenAI partnership. You want to see the power of that moat in just one number? Here it is: $625 billion. That's Microsoft's commercial RPO. Now that sounds like a bunch of financial jargon, but put simply, it's future revenue that is already locked in from long-term contracts. It's like a massive, massive pile of pre-orders from the world's biggest companies, basically guaranteeing business for years to come. Okay, let's move on and see how this all builds. A strong fortress is really only impressive if it can stand up to its rivals, right? So let's see how Microsoft's performance actually stacks up against the competition. This table pretty much says it all. While its competitors are growing in the single or maybe low double digits, Microsoft is just cruising along at around 15%. But here's the kicker. Look at their profitability. A projected operating margin of nearly 46%. That means for every single dollar of sales, almost 46 cents is operating profit. That is a sign of incredible efficiency and some serious pricing power. And what's really crucial here is that this isn't just a case of a big company getting bigger. No, Microsoft is actively taking territory from its rivals. They are gaining market share in the critical cloud battle with Azure. They're pioneering AI coding with GitHub Copilot. They're steadily growing their Edge browser's user base, and they're just completely dominating enterprise productivity with Microsoft 365. So now let's pop the hood and look inside. What are the specific gears and pistons that are driving these impressive numbers? It really boils down to this powerful combination of adding more customers, getting more money from each one, and creating entirely new products. You see, Microsoft is pulling two really powerful levers at the exact same time. First, you've got volume. They're just adding more and more users, with over 450 million paid seats for Microsoft 365 alone. Then you've got price. They're increasing how much money they make per user by upselling them to premium AI services like Copilot. It is a classic and very effective 1-2 punch for growth. Now, a fair question to ask is, hey, are they just buying all this growth through huge acquisitions like Activision? And yeah, while that deal definitely boosted the gaming division, the source material is really clear. The core engine is firing on all cylinders. I mean, Azure's stunning 39% growth in a recent quarter was completely organic. That's just pure, raw customer demand. Of course, no analysis is complete without taking a balanced look at the risks. Even the strongest fortress has some potential weak spots, so let's examine the threats that are actually on the horizon for Microsoft. The source points out several real threats to this fortress. In the cloud, AWS is still the king, and Google is a fierce rival that's growing fast. In AI, open source models could put pressure on their profits. Then you've got the regulators looking at them for bundling products, and of course the constant, never-ending battle of cybersecurity. But maybe the most telling risk? Demand for their AI services is so incredibly high right now, it's actually outstripping their own ability to supply it. How financially healthy is this company really? We're going to break it down into 3 parts: profitability, taxes, and then we'll look at the muscle on its balance sheet. Okay, first up, the incredible profit engine. This is all about how good Microsoft is at turning every dollar of sales into cold, hard profit. So let's rewind the clock a bit. Back in 2016, we're looking at an operating profit margin of 23.7%. Now, that's already pretty good. I mean, most companies would kill for that. But just watch this. Wow. Just 4 years later, by 2020, that number explodes to over 37%. What you're seeing here is just insane operating leverage. I'm talking about their super profitable software and cloud businesses really hitting their stride. That is a massive jump in efficiency. And it doesn't stop. Fast forward again to 2025, and we're looking at a mind-blowing 45.6%. Think about that. The big story here isn't just one good year, it's the trend. They've almost doubled their core profitability in under 10 years. That's world class. No other way to put it. So I keep saying operating margin, but what does that actually mean? Look, think of it this way. It's the cleanest, purest way to see how profitable a company's main business is. For every single dollar Microsoft brings in from sales, once they've paid for all the basic costs of doing business, they're left with almost 46 cents in profit. That's huge. And as an investor, a higher number is always, always better. Now, you might be a sharp-eyed investor and say, hey, wait a minute, I saw the gross margin dip a little. And you'd be right. But here's the thing. That's not weakness. It's a choice. They're pouring unbelievable amounts of money into building the infrastructure for AI. It's a classic move, really. You spend big today so you can win even bigger tomorrow. And all of this leads to the bottom line, literally. The net profit margin, this is the profit after everything is paid, taxes, you name it, is holding rock solid at an incredible 36%. That just screams financial strength. So why does any of this matter to you? It's simple. A company that's this profitable, this efficient, can pay for its own dreams. They can build out this massive AI empire without having to go hat in hand for a bunch of risky debt. It's the ultimate sign of stability and being in control of your own destiny. All right, let's move on. Section 2, taxes and the fine print. Okay, this is where things get a little more complicated, but stick with me because this stuff is absolutely crucial for any investor to get their head around. So if you just look at a chart of Microsoft's tax rate, it looks like it's all over the place, right? But it's not random. There's a story behind every big jump and dip. You've got a one-time tax event here, some stock-related benefits there. The point is, it might look messy, but it's all explainable and out in the open. So when you smooth it all out, what's the real story? Well, Microsoft's tax rate usually hovers right around 19 to 20%. And that's just a little bit below the main US corporate rate of 21%. And how do they do it? Well, it's all perfectly legal stuff, things like tax credits for research and development, and how they structure their income from other countries. This is pretty standard practice for a company of this size. But, and this is a big but, we have to talk about the elephant in the room. Buried in the fine print is a potential bill from the IRS for $28.9 billion. I mean, that's a number so big it's hard to even wrap your head around. It definitely got our attention. Okay, before anyone panics, let's add some very important context here. First, this isn't some hidden bombshell. Microsoft told everyone about it. Second, the company's management is fighting it, saying they don't owe it. So yes, it's a material risk. You absolutely have to keep an eye on it. But it's a known risk, and it's being contested. So what's the bottom line for us? It's this. Their normal year-to-year tax stuff seems totally fine and above board. But this one massive, unresolved fight with the IRS, that is the single biggest question mark hanging over the company's finances. It's the one piece of fine print you really, really need to watch. All right, for our last section, we're checking the foundations. We're talking about the balance sheet. Is this a house of cards, or is it a fortress? Let's find out. One of the best ways to test that foundation is something called the debt-to-equity ratio. Don't let the name scare you. It's just a simple safety check. It's like asking, how much money does the company owe compared to how much it's actually worth? And the rule is simple. The lower the number, the safer it is. And boy, does Microsoft have a story to tell here. See, back in 2017, after they bought LinkedIn, they took on a bunch of debt, and the ratio went up to about 1. But look what they did next. Year after year, they just chipped away at it, paid it down, and now it's all the way down to 0.12. That is a textbook example of how a responsible, strong company manages its finances. It's incredibly safe. Now, there is one thing on the balance sheet that's gotten a lot bigger lately. It's an item called goodwill. All that means is the extra money a company pays for another company above its official value. And that giant leap you see there? Well, that has a one-word explanation. Activision. That's the colossal price tag for buying the gaming giant showing up on the books. And here's what's just nuts. Even after spending all that money on Activision, even after pouring billions into AI, Microsoft is still sitting on a pile of cash and investments worth around $90 billion. That's just an insane amount of financial firepower to have ready to go. So why does this matter? It means the fortress is real. This balance sheet lets Microsoft do two critical things. First, it can laugh off economic storms that would sink other companies. And second, it gives them the power to make these huge, world-changing bets on things like AI and gaming, not from a place of desperation, but from a position of absolute strength. Okay, we've run the tests, we've checked the vitals, it's time for the final diagnosis. What's the verdict on Microsoft's financial health? The results are in, and they're pretty clear. The profit engine, that gets a strong buy. I mean, it's just a world-class machine. The balance sheet, also a strong buy. It really is a fortress. The only place we're seeing a yellow light is under taxes and governance, and that gets a hold rating, really for one reason and one reason only, that big unresolved issue with the IRS. Okay, so here's our game plan. We're going to build the case for Microsoft being a financial fortress, piece by piece. We're going to look at three main pillars holding it all up. First, how it handles its debt, which is all about safety. Second, its incredible cash machine. And third, its massive all-in bet on AI. Then we'll tie it all together with the big takeaway for you, the investor. All right, let's not bury the lead here. The single biggest takeaway from this whole analysis is this. Microsoft is, without a doubt, a financial fortress. It's truly one of the most secure, well-managed companies on the entire planet. And over the next few minutes, I'm going to show you exactly how the numbers prove it. So let's kick things off with pillar number 1, debt and safety. Look, for any company, whether it's a startup or a behemoth, debt can be a huge risk. But how Microsoft manages what it owes, well, it's basically a masterclass in financial stability. It's the foundation of the whole fortress. Now, what if I threw this number at you? 50 to 80 times. What could that possibly mean? I'll give you a hint. It has everything to do with why this company is so incredibly safe. It's a measure of just mind-boggling security. That number is something called interest coverage, and it's a really simple idea. It just asks, how many times over can you pay the interest on your loans with the money you're earning right now? The slide puts it perfectly. It's like your paycheck being 50 to 80 times bigger than your mortgage interest payment. I mean, you wouldn't be losing any sleep over that, would you? And this chart right here shows you what that looks like in the real world. That huge bar on the left, that's the money Microsoft is making from its operations, over $128 billion. And that little bar next to it, that's all of its long-term debt. It's not even a fair fight. In fact, their profits could literally crash by 70%, and they could still easily cover the interest on their loans. That, my friends, is the definition of financial safety. So the verdict here is a crystal clear, strong buy signal when it comes to safety. And just think about this for a second. Microsoft makes so much cash that it could pay off every single dollar of its long-term debt in less than a single year. Wild, right? So where does all that amazing cash actually come from? Well, that leads us right into our next pillar. All right, on to pillar number 2, the cash machine. You know, a ton of companies can report these huge, flashy profits on paper. But a smart investor knows there's one critical question you have to ask before you get too excited. Are those profits just some kind of accounting fantasy, or are they backed by actual hard cash flowing into the company's bank account? Honestly, this is one of the most important questions you can ask about any business, period. And this table gives us the answer loud and clear. Over on the right, you see PAT. That's profit after tax. That's the official number. But look at the column right next to it, CFO, which stands for cash from operations. That's the real cash that actually showed up. And every single year, the real cash is way higher than the reported profit. That ratio is the magic number. It's always over 120%. And that brings us to a golden rule for all investors. When a company consistently brings in more cash than its official profit, that is one of the most powerful signals you can find of high-quality earnings and just plain excellent financial health. There are no accounting tricks to hide behind here. This is real money we're talking about. So it's no surprise that the verdict from the source on this is a solid buy signal. The earnings aren't just real, they are absolutely exceptional. Okay, so we know the company is safe, and we know its profits are backed by a mountain of cash. So what are they doing with all that money? And that brings us to pillar number 3, investing in AI dominance. We've established Microsoft is super safe and it's a cash-generating monster, so what are they doing with it all? Well, they're on an absolutely eye-watering spending spree. But this isn't reckless. It's a massive, calculated bet to own the future. Just take a look at this timeline. This shows their capital expenditures. That's the money they spend on big physical stuff like servers and buildings. Look at that surge. It goes from around $15 billion in 2020 to a projected $64 billion in 2025. That explosion, that rocket ship of spending, it's pretty much all for one thing: building the AI data centers that will power our future. But here's something that's so important to understand. Not all spending is the same. There's what you call maintenance spending, just keeping the lights on. But then there's growth spending, and that is an investment to build whole new ways of making money. Microsoft's AI spending spree is 100% in that second category. They are literally building the factories of tomorrow. So the billion-dollar question, or in this case, the $64 billion question, is it working? Is this huge bet paying off? Well, this one stat is incredibly telling. Commercial bookings, which is basically big customers signing up for their AI stuff, grew a staggering 230% year over year in a recent quarter. That is stunning, and it's a huge validation that the investment is already bearing fruit. Okay, so we've looked at the 3 pillars of Microsoft's strength: its safety, its incredible cash flow, and its strategic AI bet. So let's bring it all home. Let's look at the final investor takeaway and what this all means for creating real value. Here's the beauty of it. Because that internal cash machine is so incredibly powerful, Microsoft can do everything all at once without even breaking a sweat. It can fund that massive AI expansion, buy back its own shares to make them more valuable, pay out dividends directly to shareholders, and pay down the tiny bit of debt it has. It is a beautiful, virtuous cycle. Okay, let's dive right in with the first and, you could argue, the most critical pillar: the people steering the ship. A company is really only as strong as its leadership, so let's see how Microsoft stacks up. Just look at this number: $282 billion. That's Microsoft's annual revenue today under CEO Satya Nadella. Now get this, when he took over back in 2014, that number was just $86 billion. I mean, that's not just growth, that's a complete reinvention in about a decade. So the real question is, how on earth did he and his team pull that off? Well, it really boils down to a few brilliant moves. First, Nadella pulled off this masterful pivot, turning the entire company into a cloud and AI-first leader. He and CFO Amy Hood also made the company way more profitable, almost doubling the operating margin. And this is crucial. They communicate clearly, using data, not hype. You add in smart decisions about where to put their money and an independent board that keeps everyone honest, and, well, you've got a recipe for massive success. So the takeaway here is pretty straightforward. The analysis gives Microsoft's leadership a clear buy signal. We're not just talking about a good team. The analysis says this is one of the best leadership teams in the entire tech world. Zero red flags. For an investor, that means you can have a really high degree of trust and predictability. All right, let's switch gears and talk about the next big thing: ownership. Understanding who holds the shares and who has the real influence is absolutely fundamental if you want to understand how a company is governed and how stable it is. This is a question you should ask about any company you invest in. Is there one founder or a family that holds all the cards? Or is the ownership spread out among lots of different people? The answer tells you a whole lot about how decisions actually get made. And this slide lays it out perfectly. On one side, you have what's called a promoter-led company. Think of a company where one person or family has the final say. But Microsoft, it's what we call a widely held public company. This means no single person or group is in control, which is generally a good thing. It leads to stronger governance because management has to answer to a whole lot of different shareholders and an independent board. And this just shows you how widely held it really is. I mean, look at that slice. A whopping 74% of Microsoft is owned by big institutions. We're talking about the Vanguards and BlackRocks of the world. This is a huge vote of confidence from the smartest money on the planet. So let's just quickly recap what this means for you, the investor. There's no controlling family. Even Bill Gates isn't a controlling stakeholder anymore. The people in charge, they get paid when the company does well, which means their goals are your goals. And that new $60 billion share buyback, that's basically management shouting from the rooftops that they believe their own stock is a fantastic long-term investment. Okay, next up, let's look at Microsoft's incredible network. Because no company, not even one this big, is an island. Its ecosystem of partners is a massive and, frankly, often overlooked source of its strength. And wow, right at the center of it all is probably the most important partnership in tech right now: OpenAI. Microsoft isn't just a passive investor here. Its Azure cloud is the exclusive engine that powers all of OpenAI's groundbreaking models. This relationship is so powerful that it drove a 112% increase in related bookings in just one quarter. That's incredible. But it's not just about OpenAI, not by a long shot. Think about it. You've got over 450 million paid seats for Microsoft 365, creating these super sticky relationships with businesses. Then you've got all the hardware makers like Dell and HP who make sure Windows is everywhere. And don't forget the armies of consultants at places like Accenture, who are basically an extension of Microsoft's sales team. It's this amazing self-reinforcing system. Okay, but you might be thinking, isn't that a little risky, putting so many eggs in one basket? And that's a fair question. Being so tightly linked to one partner definitely creates what's called a concentration risk. The analysis flags this as a tail risk, a small chance of a big problem that you have to keep an eye on. But for right now, it remains an incredibly powerful competitive advantage.
We all know Microsoft is a phenomenal company. It's changed the world. But when a company gets this huge, you gotta wonder, have we missed the boat? Is the stock just way too expensive to even think about buying right now?
So, to figure that out, we need to do a little digging. First up, we're going to decode the price tag. Think of this part as learning how to read the stock's nutritional label. It tells you exactly what you're paying for.
Okay, so the main tool we're going to use is called the price-to-earnings ratio, or PE for short. Don't let the name scare you. It's super simple. It's basically the stock's price tag. If a stock has a PE of, say, 20, it just means you're paying $20 for every $1 of profit the company makes in a year. So, what about Microsoft? Right now, Microsoft's PE ratio is sitting around 29. So for every single dollar of profit Microsoft earns, investors are willing to pay 29 bucks. But, a number like that is pretty meaningless by itself. We need some context to know if that's good or bad. And here's that context. If you look back over the last 5 years, Microsoft's PE has bounced around between 25 and 40. So at 29, well, it's not at the crazy expensive end of its range, but it's for sure not on the bargain rack either. This is what you'd call a fully priced stock. Basically, all the optimism and good news about the company, it's already baked right into that share price. Now here's a really cool trick. If you flip that PE ratio upside down, you get something called the earnings yield. It kind of shows you the return you're getting from the company's profits right now. For Microsoft, that's about 3.4%. Okay, now look at the other side. A super safe, risk-free 10-year government bond will pay you about 4.5% right now. And that should make you pause. Right now, you can get a higher return from a boring, safe government investment than you can from Microsoft's current earnings. For anyone looking for a good deal, that's a big yellow flag. It means you're taking on all the risk of owning a stock for what is, right now, a lower payout.
So, if the valuation looks a little steep, what gives? Why are so many smart people willing to pay this price? Well, that brings us to our next section, the case for what we're calling Fortress Microsoft. To get the price, you have to appreciate the absolute quality of the business.
People pay a premium for Microsoft because of all this. The company has a massive competitive moat. Just try to run an office without Word and Excel. Good luck. Switching is just too painful. Then you throw in their lead-in AI with OpenAI, a balance sheet that's built like a tank, unbelievable cash flow, and one of the best management teams on the planet.
And if you want to understand just how powerful that business is, get a load of this number. Microsoft has $625 billion of future revenue that is already signed, sealed, and delivered under contract. That level of predictability for a company this size is just insane. And speaking of that fortress balance sheet, just take a look. All that cash they have just sitting there, it absolutely dwarfs their long-term debt. This kind of financial firepower means they can invest in anything they want, buy other companies, and just sail through any economic recession without even blinking.
So the picture starts to get a lot clearer, right? The reason for that premium price is that you are buying an absolutely elite, top-of-the-food chain business. It has these deep advantages that are almost impossible to compete with, and it's probably one of the most financially stable companies in the entire world.
But of course, nothing is perfect. No investment is a sure thing. So now we have to look at the other side of the coin. Let's talk about the case against, because even a fortress can have some vulnerabilities.
So here are the top risks to keep on your radar. First, there's a huge ongoing tax fight with the IRS. Then there's the cost of AI. It's unbelievably expensive to build all those data centers. And, funnily enough, some of these new AI products might actually be less profitable than their old software. Then you've got the usual worries like supply chain problems and governments around the world looking to regulate them more heavily.
Let's just focus on that IRS dispute for a second, because it is a big deal. The potential bill that Microsoft might have to pay could be as high as $28.9 billion. That is a staggering amount of money. But, and this is a really important but, we have to remember who we're dealing with. For almost any other company on Earth, a $29 billion bill would be a catastrophe. For Microsoft, it's a really, really bad day, for sure, but it's manageable. Remember that fortress balance sheet? They can write the check, and it won't stop them from doing what they need to do.
Okay, so let's bring it all home. We've seen the kinda high price, the incredible, world-class business, and the very real risks. It is time for the final verdict, where we weigh that amazing quality against that not-so-amazing price.
This little scorecard really tells the whole story. Look at it. Business moat, perfect score. Balance sheet, perfect. Growth prospects, perfect. 5 out of 5 across the board. But then you get down to valuation, the price, and margin of safety, and yikes, 2 out of 5. That's the core conflict right there in one table.
And it leads us to a really simple way to think about it. What we've got here is an A-plus business that's selling for a C-plus price. The company is fantastic. The stock price, it's just fine.